Well, good morning, guys. It is Clark with Ruoff Mortgage coming to you with another live version of our weekly Wednesday. And today we want to talk about a topic that is some people don't even know that they can even do, okay? And that is leveraging the home that you own, whether it be the house that you live in, or it might be an investment property, or some other second vacation home or whatever it is, to be able to consolidate some debt, okay? So let's first take this with a premise to say, okay, you know what? Maybe this isn't your story. Maybe you don't need to do this. But I guarantee you that you know someone who does. And the thing to understand is a lot of people, maybe including yourself, don't even know that you're allowed to do this, okay? So with that in mind, I want to make it very clear. The strategy is a way to be able to free up cash flow for your home. It is not a way so that you can go out and spend, get more, obtain more consumer debt. That's not what the strategy is for. But what it is to allow you to be able to free up more cash flow so that things may become a little easier when it comes to your monthly debt load. And the last thing I'm going to show you is it's a way for you to be able to pay your house off faster as well by freeing up that cash flow. So it isn't a matter necessarily that I'm looking to help you from a financial standpoint of, hey, let's free up more cash flow per month so that you can go out and spend more money. What we want to do is one of two things. We can either take and reinvest that money into some type of retirement or investment account so you can get a return on your investment, or to take and reinvest that into your home, kind of giving away the punchline here, and pay your house off even faster. So let me kind of show you what this looks like. And once again, even if this is not your story, I guarantee you know someone who would benefit from this discussion and what we're looking at here. So what we're going to do is talk about a person who has some debt, okay? And I'm going to give you a generic scenario. I looked up and I researched some average interest rates that people would have in these particular scenarios. Some are going to be paying higher, some are going to be paying lower, but we have to have some type of something to come to do a determination so you can kind of see what's going on. So let's talk about that. So in our situation here, this particular client or individual has a $150,000 mortgage, okay? And right now they're paying 4.5%. All right. They also have a $18,000 in credit card debt. Okay. Not a number that most people will be comfortable with, not a ridiculous number. If you look at national averages, this number is significantly higher than this, but we're not going to play on that average. We're just going to kind of do something that's a little more manageable and realistic maybe for the people that we know. But once again, some people have less and some people have more. The larger this number is, the more this discussion will benefit the individual, okay? The average interest rate of revolving, that is consumer debt, credit card debt, across the board is 21%. Yes, I didn't stutter. 21%. Ridiculous number, okay? And by the way, we'll talk about the term here, okay? This is a 30-year loan. If you make the minimum payments required on this debt, it'll take you 20 years to pay that off, if you can believe that. That's if you never spend another dime. And anybody who has credit card debt knows that you pay it down and things come up and you have to use it again. You pay it down, you get down really close to the end, and then all of a sudden something in life happens, and then you use it again. This is assuming that this $18,000 card, or cards, plural, never get used again. 20-year payoff. That's a long time. Okay. Then this individual also has a car loan that they owe $20,000 on. Okay. The average car note based on credit scores. Now there's some that are lower, but there's some that are significantly higher, almost 3 times as high. So I'm just using the average because once again, we have to come to some type of determination. That is 7%. Okay. And we're going to look at a 5-year car loan. And then lastly, we want to look at a student loan which is something that is on the forefront of my family's mind because I have a senior in high school. And so we're having the discussion of, we really don't want you to take on a ton of student loans because I see the impact that it has on people's lives moving forward. And so this is a discussion that we're having to work through, and the importance of applying for private scholarships and so forth. So anyways, with this individual, I have $35,000 in student loans, and the average student loan rate right now is 6.6%. Okay, those are typically a 20-year term once again. Okay, so as you can see here, the total of all of their debt is $223,000. Okay, now there is a thing that's called a blended rate. What that means is it takes and it puts each of these, of the $223,000 in debt, it takes each of these and it weights it compared to how much it is. So clearly the mortgage is the largest weight, the total percentage of the 223. So it gives that 4.5 a higher weight. It's not just an average, taking the 4 and divide these rates by 4. It doesn't work like that. But it's a weighted average. The blended rate for what this person is paying right now on that $223,000 is 6.386%. So even though they feel like, well, I got a really good rate on my mortgage, which, by the way, if you have an interest rate that's over 4.25%, you need to have a discussion with us because interest rates are still really, really good right now, and we don't know how long they're going to stay low, so take advantage of that. But they may feel like, you know what, historically, 4.5 is good, and it is historically, looking at the averages. However, right now, it's considered a high rate. We have all of our marketing right now is saying if you have over 4.25%, you need to have a conversation with us. But so they say, well, my mortgage is good, but they have equity in their home. Okay, so in this situation, let's just say their house is worth $350,000, whatever. Okay, and they have equity in their home. That the one thing about equity to understand is this: it is a paper number. It's a number that is there that is never realized until either A, you leverage it, or B, you actually sell your home. So here's the situation. You get ready to sell your $350,000 house when you started the situation, and if something happens in the market, all of a sudden now you only get $320,000 for it. Let's just say hypothetically, right? So you have lost $30,000 in equity. Well, what we have to understand is that was that equity actually even truly there? To say that my house is worth $1 million, unless somebody is willing to pay $1 million for it, it's not. And so our equity is kind of like this thing that's sort of there, but it's an abstract concept. It's an abstract reality of what we actually have available to us. So what this strategy does is allows you to be able to leverage something that is abstract and help yourself in real time and impact you to the fullest, okay, financially. Now, I'm not recommending, by the way, anytime, let me give a little disclaimer here. Anytime I have a discussion with a client and we go over this type of strategy, and they say, my hope for them is this. I say, listen, we're going to definitely be able to save you money every single month. We're definitely going to be able to free up some cash flow. My hope for you is that you're able to then in turn put some money in the bank, get some reserves, and then you're using your debit card for these and, paying cash for these different items as opposed to running up this debt again. If you call me 3 years from now and you have another $20,000 in debt, then we didn't really leverage the strategy to its fullest, okay? So this is not an excuse. This is not using our house as an ATM. This is a strategy where we find ourselves in a position where we can't really see the light at the end of the tunnel. We have an abstract equity that's available to us, so we're leveraging that to be able to positively impact our cash flow every single month, okay? So here's what this looks like. Oh, by the way, sometimes I talk to people, well, they'll have all of this, but they don't have a mortgage. And they're like, well, how can I possibly do that? You actually can do this exact same strategy, even if you don't have a mortgage in your house. So just clearing that up because don't want to make any assumptions. I have had that client say to me, I didn't know you could even do that. So just make sure you're aware of that. Okay. So what this does is now, and by the way, I did the payments per month, all right? And for space sake, I wanted to make sure I pointed this portion out. But if you just trust me in the fact that I did all the calculations based on these length of terms, this person is writing checks, not including their taxes and insurance. So we'll just ignore that right now because it doesn't impact that. Whether they do debt consolidation, refinance, whatever, their property taxes are going to be the same thing. So let's just pretend for our example that they're not escrowing and they're paying their taxes and insurance on their own because this has zero impact on that anyway, okay? So if they make the minimum payments on all these things here, right, and they take the full term, right now they're paying $1,816 a month, okay, on all of this right here. Now, what we would be able to do is consolidate all of this into one simple fixed rate payment that they're able to leverage against their income taxes. This you can't. The car you certainly can't. Some situations, this is, depends on income levels and so forth. This is not a tax seminar, but there are times where this is actually, you can leverage that. But certainly these larger interest items, we cannot leverage against our income taxes at all, right? So what we would be able to do is consolidate everything into one clean package and allow you to be able to consolidate that into one, okay? So here's what we're looking at by doing that. This payment on all of this stuff, this $223,000, I even factored in rolling in the closing costs so you wouldn't have to pay anything. I'm gonna box this off because this is our new situation. Your payment for everything, $1,050 a month, okay? At a 3.75% interest rate, 3.86% APR. What that does is that frees up $770 a month in cash flow. So if I had a way for you to be able to save an additional $770 a month by leveraging your home's equity, and you would be able to eliminate all of these things, that would be a great way to be able to help yourself. Are you contributing to your 401k right now? If the answer is no, this provides you opportunity to be able to do so. Are you, do you have an emergency fund? Do you have cash set aside that if something happens, if your furnace goes out, if all of a sudden now you got a roof leak, do you have the ability to pay for that, or you have to use credit cards for that again, right? So this is a way for you to be able to save money and leverage that. You say, well, Clark, I don't necessarily want to take my consumer debt that I have accumulated and I want to stretch it out over 30 years. I'm glad you said that, okay? So say you have retirement, you're contributing to your retirement, that's good. You have an emergency fund set aside, but you use it for only emergencies. When we go and go to the store at Target or whatever it is, consumer debt, we were using our emergency fund for that. We didn't use that for our car loan and our student loans and so forth, right? But we're looking for cash flow on a monthly basis. We don't necessarily want to stretch it out and pay for 30 years. Okay, so maybe cash flow isn't your biggest consideration, but you're tired of paying all this 6.38% blended rate. Well, here's a strategy for you. If you reinvest that $770 back into your mortgage, and you basically just keep on writing a check for your mortgage at $1,800 every single month, watch this. You will save yourself, or I should say you'll pay off everything, including your house, in 13 years. 13 years. And by the way, let me pull this up real fast. You won't see just 1 second. You're going to save yourself the difference here in interest savings over that life is over $120,000. Let me say that again. Not only are you, if cash flow isn't your thing and you don't really need it because you're positioned, you just got yourself kind of into a little bit of trouble here. Okay, didn't really see the light at the end of the tunnel. How do I deal with this? What you can do is you can leverage your home, leverage that abstract equity to be able to put yourself in a better position. And if cash flow on a monthly basis isn't your thing, right? Everybody's got their own story. I've been talking to the people that have this situation. Some people I've had people over my career where I saved their home. Clark, you don't realize what you've done for us. Now we're able to put our kids in the school that we wanted or whatever, right? Everybody has their own story. But if your story is such that you don't necessarily need it on a monthly basis, but you find yourself in this position, and maybe you're 10, 15 years away from retirement, and on your current path, all of this stuff is not going to be paid off in that length of time. Well, this strategy allows you to be able to do that. You can have your house paid off in 13 years. Not only your house, but all of these other things are paid off in 13 years. And now you've positioned yourself so that you can retire as long as you play your cards right, everything else. This is what helped. This is me. I'm addressing past behaviors. Your future behaviors are on you, right? So we can talk about that on another time. But what this allows you to be able to do is position yourself so that you are debt-free come retirement, if that's your story. So it's a great way for you to be able to leverage something that you have available to you to consolidate, put yourself in a better spot. Hopefully this was helpful for you guys. If you have any questions about this or anything else, do not hesitate to reach out. And as always, choose a great day. We'll see you next week.